Good day, guys. Marlon here again with another trading video. And basically, what I'm sharing it to you, the journey I had to go through to find the markets I really wanted to trade. Now, traded market correlation. Now, if you see a negative, it means that if the Australian USD is going up, then the Euro GBP is going down. If you see negative, if you see positive 20, it means that if this one is going up, that one is going up. But there's only a small positive correlation. Like anything over 70% has got a really good positive correlation going for it. Okay. So, but what I had to do, guys, to work out this correlation, there's so many different markets that I was looking at. And I was looking at these markets, looking at them, just different combination, because what I'm trying to do is to not basically take in the same trades, so that's the whole point of doing this activity, right? So then I got to here, and this is where I think I finished, because the correlation between the different markets that I've chosen here, because I've got indices, I've got gold, and so on and so forth, guys, which I'm good. But one thing I'm going to say now, let me give you an example of what I'm talking about here. Let's find a positive correlation. So New Zealand USD 88% and 75% in terms of positive correlation. So if you're looking to take the New Zealand USD trade, and you've got a setup for CAD JAPI, and you've got a setup for Euro USD, then the likely chance that those three trades are going to be the same. So what you want to do is not take all three, or say, for example, you're not sure which trade is going to trigger based on where you're going to put your entry. What you could do, if you normally risk, say, £100 per trade, and you said, okay, I want to take this trade, and what you could do, you could divide that £100 into three parts. So 33, 33, 33, and 30 pence. So it's a risk per trade. So at least whichever one triggered, you're into the trade, but then you didn't over leverage. But then, I've done this in the past where I made a mistake where, I'm risking £100 per trade, but put £100 on each transaction. So then instead of risking your £100 per trade, you're actually risking £300 on this trade. So you got to be mindful when it comes on to correlation, and especially positive correlation. Now, you've got also what we call negative correlation. Negative correlation means that as one market is going up, the other one is going down. So you've got to be mindful of correlation, and also trade in the same market. So you're doubling up, or one trade could cancel the other. So say, for example, if this one here has got, say, negative, let's find it, negative 83, between the Euro USD and the USD CAD. So as one is going up, the other one is going down. So you might be buying on one and selling on the other, and it's canceling each other out. But the good thing about it, I would recommend, is that you've got a sheet like this, a market correlation sheet in front of you. So therefore, you don't wait until you place a trade, then you start looking for correlation. You can see, so you can either split the trade accordingly, or you could just put the trades in accordingly.